Hi, my name is Mike Tusaw. I'm a financial advisor from St. Charles Wealth Management. Today, we're going to discuss vertical call debit spreads. Now, before we get into the vertical call debit spread, what I want to start with is a quick review of just simply buying a call option. In this illustration, you can see that the stock price is at $50 per share. And let's say that we're bullish on this and we want to buy an in-the-money call option. We want to buy the 45 call for this stock. The cost for that 45 call is $6.15. Now, we will have upside participation on this stock on anything above 45, but understand we paid $6.15 to get that participation, to get that privilege. $5 of this is in the money, but we pay $1.15, $6.15 minus $5 of how much it's in the money, to actually get that privilege in terms of time value. So the question that you need to ask yourself is, why would you want to do a call spread to begin with? What's the reasoning behind it? What's the purpose of it? How can it help you? Well, quite frankly, it's very simple. Cost. Doing a vertical call spread can reduce the cost of the bullish option position in and of itself. So if you're concerned that the value or the price that you're paying for the option is too great, then a vertical call spread would be something to consider. So there's advantages and disadvantages of trading a call spread, but before we get into that, let's go over the illustration on the screen of what a vertical call spread is. Also, there are different reasons to select different time frames for vertical call spreads, as well as different strike prices. We have strike price selection videos as well that we would recommend that you watch if that's a question with which you have. So in this illustration, the stock is priced at $50 per share. We're looking at buying the same call option that we did in our previous example, the 45 call for $6.15. Now, if you feel that that's too much of a price to pay, then perhaps you could sell the 55 call against it for $1.15. Now, what does that do? Well, number one, it reduces the cost from $6.15 to $5. You had time decay on this before with just a call option, but now that time decay is mitigated because you sold that 55 call against it. So there's good and bad to everything. The fact that you're paying less money for this is good. What's the bad? Well, you'll see from the illustration that the upside is limited. You'll notice that that line on the far right of that little mini S figure is there, and that means that your profit is limited. You will never make any more money past $55 per share upon expiration. So in other words, you paid $5 for this spread. Your net debit of $5 is what that's written up there. But the most this can possibly be worth is $10, and that's the difference between strike prices, 55 minus 45. Now, if you feel that that's a sustainable and good risk reward, this is something with which to consider. If you feel the stock is going to go to 55, 60, 70, and you want to be a part of that, then a call spread is not a good choice for you because you're going to be missing out on that. You may want to consider buying a call option and managing risk that way if that's what your sentiment is on the stock. Now, the other thing to consider when doing this is that you will not have gamma working in your favor. So in other words, if the stock goes higher, the call option itself would do better initially than the call spread. And the reason for that is that you have one option working for you. In this case, you have one option working for you, which is the 45 call, and one option working against you, which is the 55 call. Now, the 45 call is working more for you than the 55 call is working against you. So it's still a bullish trade. However, the thing to consider is that you won't get the reward as quickly as you would like by comparison. Now, all other option trading factors play a part in this. Delta, gamma, theta, theta, rho, it just typically works a little bit slower. So in other words, time decay would happen on this, but it would happen slower. Now, of course, in this case, we don't technically have any time decay risk because we've mitigated it through the short call, but it doesn't always work out that way. Also, volatility plays a factor, just not as much as a single leg option, because if volatility goes lower, then it also goes lower in your short option, and it won't have as much of an effect because it's mitigating or helping to mitigate the time value going down or the volatility value going down in the long option. So once again, there's advantages and disadvantages to both of these trades. If you are looking to do a long call option, you're looking for more movement. If you're looking for a spread, you kind of have an idea of where the top would be within your sentiment of the stock itself. If you enjoyed today's video, please subscribe. That's how we get our content out to more people. If you're looking for a financial advisor who uses call spreads very frequently, assuming it's appropriate for the client, of course, feel free to reach out to me. You can follow me on Twitter at Mike Tusaw. I try to put out a lot of content. And you can also go to my website if you'd like to get in touch with me, stcharleswealth.com. Thank you and have a wonderful day.